Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly video update on Friday, June 28, 2024. The first half of this year couldn't have gone much better for equity investors. The S&P 500 Index, NASDAQ Composite, and Dow Jones Industrial Average reached all-time highs. Only small-cap stocks, as measured by the Russell 2000 Index, failed to exceed their previous record achieved 3 years ago. So here's a chart of the S&P 500. I'm just going to show you year-to-date here, and you can see really since mid-April the steady rise. Now it's leveled off here during the past 2 weeks, but nevertheless, you look at this as the first half of the year, you will gladly take it. Now the stock market's rally this year has not been driven by Fed rate cuts. That hasn't happened yet. But the likelihood of a rate cut during the third quarter increased this morning after the personal consumption expenditures numbers for May were released. So I'm going to just show you, and I have a link to this website in the body of the text here. So last month, the PCE price index rose at its slowest rate in more than 3 years. So here is the month of May in the far right. And again, if you look in May, core PCE, excluding food and energy, grew 2.6% over the past year, down from 2.8% during each of the previous 3 months. So if you go all the way to the bottom right corner, that very last figure is PCE excluding food and energy, and you can see it's 2.6. Then in April it was 2.8, March 2.8, February 2.8, January 2.9. So it finally broke the stalemate here over the past 3 months. Now that's still above the Fed's target growth rate of 2%, but it's getting close enough to give the Fed more leeway in balancing its dual mandate to keep inflation low while maximizing employment and thereby preventing the economy from contracting. For that reason, don't be surprised if the yield on the 10-year Treasury note slips below 4% soon. And here I'm going to go up here and hopefully pull up a chart of the CBOE. Where are you? Here you are. Okay. Today's PCE report should put an end to any talk of a possible rate hike to slow down inflation. It may also influence the Fed to adjust its dot plot when it issues its next policy statement on July 31st. So here's the yield on the 10-year Treasury note over the past year, and you can see that it peaked near 5% last October, and then it dove steeply as the incoming inflation data at that time suggested that the Fed's monetary policy was really starting to have an effect. But then you can see it bottomed out right here last week of December, a little under 3.8%, because it started rising when the incoming inflation data in January suddenly started to level off, and people became concerned that the Fed may not be able to cut rates as soon as they like. Then you can see it peaking over here in late April, but since then, with a couple of blips, they're clearly coming down. Now you may recall that the 10-year T-note yield briefly fell below 3.8% in late December, shortly before an expected uptick in inflation data caused the Fed to revise its dot plot and change its language regarding future rate cuts. Now I believe we've returned to that environment. So what I'm saying is this area over here, I think we're looking at something similar where the market is going to expect the Fed to continue to cut rates. So we're really kind of maybe about halfway down the slope that preceded the bottoming out here in late December. That's my opinion, and only time will tell, but that's what it looks like to me. That is good news for income investors who heeded my advice to buy bonds now last October, and I included a link to that article in case you missed it. The following day, the yield on the 10-year T-note topped out near 5%. Over the next 2 months, the Vanguard Intermediate Term Grade ETF gained 10%. Now that's unusual because bond funds usually barely go 10% one way or the other in a full year, much less in 2 months. But that was how steeply rates were dropping at that time. Now it has lost some ground since then as the Fed backed away from its original dot plot for this year. But once it becomes apparent that a rate cut is on the way, I expect this fund to start rising again. I also expect commodity prices to keep falling, which is good news for consumers since they ultimately bear the brunt of higher input costs. So I also included a link to this page from the St. Louis Fed. Now this is the past 20 years, okay, of basically a global index of commodity prices. And you notice commodity prices started running up because back then the Fed was suppressing interest rates to pump up the real estate market, and then it crashed. So here's the big drop when the recession hit. Then again, the Fed started printing more money effectively, and guess what? Commodity prices ran back up and stayed up. Now, here is where, again, the Fed was kind of keeping rates low, raising them. But right here, this line here, of course, that was the onset of the coronavirus pandemic and then the huge spike. So from a longer term perspective, people say, well, how much can, lower can commodity prices go? Well, just to kind of hit this historical average, which they're slightly above, they could still come down some more. I mean, the fact of the matter is that the U.S. economy is on a roll. Unemployment is low, inflation is falling, and the stock market is rising. You may ascribe that success to whatever factors you like, but the empirical data cannot be denied. 4 years after the outbreak of COVID-19 destabilized the global economy, it appears our financial system has regained its footing. Thank you. That's this week's PF Update, and I look forward to talking to you in another week.